Hello people, let's start with America and the S&P, Standard & Poor's 500 index, and this goes back 1 year. Few things to note here, I think. October is going to be one of the best months for the S&P ever, certainly in the top 10. But look at that jaggedy stuff in September. That was ridiculous, wasn't it? Up and down at nearly, some of those moves were nearly 10% from top to bottom. Ridiculous great swings up and down. Most confusing. Obviously things aren't settled. What else can we note? It's a 1 year chart, so it is above where it was a year ago, but about the same as it was at the start of the year. You see, November it starts and January is up, so it's above where it was at the start of the year. So the S&P is probably up about 4% or something like that on the year, and that's not much after all that up and downness. But these computers absolutely love this. These fast computers that do all the trading nowadays, they love all this up and downness, because they chase it up, chase it down, and make a fortune on the way up and on the way down. It's of no interest to them whether the stock market is on the way up or on the way down. And we can even say an awful lot of this up and downness is because of the computers. They're just chasing themselves up and down. Anyway, let's go back a bit further. This goes back 5 years. So takes us back before the Great Recession started, and you can see that dip in the middle is the Great Recession, dropping down to the famous 660 lows of March 09, and we can see where we are now over on the right at 1250, let's say, is still below the 1550 that it was before the Great Recession. So that's going back 5 years, and this C chart is going back to 1950 or something like that. And you can see there's been huge progression up from 1950. If you look to 1995, that's a real kick up. 1995 up to 2000 was when everyone had great belief that there was going to be very cheap energy for as long as anybody wanted it, and machinery, computer technology, etc. was going to revolutionize everything, and the world was going to be marvelous. But from the crash, from the euphoria of that in 2000 to where we are now so 11 years, and it's come down from 1600, been back up to 1600 once at the peak of the housing boom. But from the dot-com boom, the housing boom, I think this last little up we can call the central bank boom. The central bank boom hasn't got it up as far as the tech boom or the housing boom. So 11 years on, it's 1250 down from 1600. Right. I'll show this chart again that we used a couple of days ago. I used a couple of days ago. It's a good chart, and this time I've highlighted the blue line, which is the average price paid for a barrel of oil across this entire time scale from 69 to 2011, and it was $35 a barrel. And we can see it was at about 01, 02 sort of time that the price being paid was above that average price, and it has coincidentally since been then that we've had a housing boom and a central banking boom, but the S&P stock market has not been it hasn't retained or regained the heights of 2000. And I think it's reasonable to imagine that the price of oil paid has a lot to do with it. Right. Surprisingly, we're going to jump to the Daily Mail online now, and Frankenstein Finance how supercomputers preying on human fear are taking over the world's stock markets by Robert Harris, a surprisingly good article. From it we get this. How have we got ourselves into this mess? After all, we were supposed to be living in an era of unprecedented peace and prosperity. Communism had collapsed and the threat of nuclear annihilation had receded. Immense advances in computer technology were creating whole new economies. Vast markets were opening up in the developing world, and above all, we were supposed to have learned enough about economics to have created the necessary institutions, the World Bank, the International Monetary Fund, the G20, the OECD, all to ensure we never repeated the mistakes of the 30s. Where did it all go wrong? And from there I'm going to jump back to the United States, to New York Times, and E. Reinhardt with what does recapitalizing banks actually mean? Now, I picked this up this morning, and it's the last free article that I get this month from the New York Times, so 29th I'll probably be all right. And it's a very recommended article for understanding stuff. But principally, what does recapitalizing banks actually mean? Have we not heard it endlessly? And he does it well. Surprisingly, he starts with Europe and continues the theme throughout the post. But the theme is, what does recapitalizing banks actually mean? Starts with, in a recent lead editorial, "Will Mrs. Merkel wake up this time?" The New York Times lectured Chancellor Angela Merkel of Germany on her citizens' duties towards nations that have lived for years beyond their means and now need financial aid, and toward European banks that, though through their lax myopic loan policies, aided and abetted the living beyond means. So having a go at countries that have lived beyond their means and banks that have encouraged, aided and abetting the people and countries living beyond their means. And obviously the article links this into the United States and the people of the United States that were aided and abetted to live beyond their means by the banks. And we get a couple of powerful charts from this article. Fig 1 giving us a typical bank's balance sheets in 2007, before or causing the Great Recession. Now, if we go to the bottom right, the typical bank borrowed between $30 and $40 for every $1 of owner's equity to buy assets. Now, it's very hard, I can't do it in one video or even 20 videos, to change people's minds about what a bank is. It's basically a business to make money and not a service. But it's very hard to explain all this. Capital cushion, top right, yellow, contributed by the bank's owners. This is the equity capital. And over on the left, you've got the assets that they'd bought, including top left grey, the structured securities like mortgage-backed securities, etc. And then we move on to figure 3. There are more, obviously, in the article, which I do highly recommend, and I was so glad that I could hang on for this one last article from the New York Times. Then, after the crash, let's say, we're in 2009 and 10 now, or they've had it in 2008 even, the mark-to-market balance sheet. So, top left, now we've got evaporated asset value, that's gone. So the top green is realistically realizable value of the structured securities, the mortgage-backed securities, and that the rest of those acronym things. Other assets, I think, have stayed the same. Debt on the right at the bottom stays the same, but at the top, the amount by which debt exceeds the value of the assets. So now we have the equity capital has gone completely, and that is technically an insolvent bank. It doesn't need liquidity because it is insolvent. Liquidity would mean that all the assets on the left could be sold to pay off the debt. But now all those assets, even if sold, will not pay off the debt. That is a definition of not now illiquid, but insolvent. But obviously central banks are helping them through their insolvency. And we get to the end of the article. And I'll read. Okay, this top paragraph is a bit dodgy. If it's a bit sounding difficult if you're not into this sort of thing, but really is very simple. In calculating these balance sheet ratios, see, that scares most people off to start with, but these capital weightings, and they've got to raise capital, they've got to raise their capital structure, and all these other wordings that we're hearing in the news. In calculating these balance sheet ratios, not all assets are treated equally, and we can imagine we've got assets on that left-hand column where some were mortgage-backed securities and other acronym things that were well dodgy, and other assets were not, and we'll come to that. Okay. Not all assets are treated equally. Cash on hand, for example, does not have a risk of declining on dollar value, not to be confused with declining in real value through inflation. We can understand that. Yeah, they've got an amount of asset which is cash, not much. But it's not going to disappear. The only way it's going to disappear is by inflation eating away at it. So what weighting should that have? What should they have in reserve for the inflation? Effectively, they say nothing. There is no need to hold an equity cushion for cash. Similarly, high-grade bonds like United States Treasuries or German government bonds, Bunds, face only a low risk of declines in dollar values and, realistically, might require at most a very small equity cushion. Okay, so if to set store for the time that there might be a depreciation in those assets, they want equity to be there, so the equity can be, equity was this side, was it? Equity can be eaten into before the to that. When equity is being eaten into, that's probably meaning illiquidity. But if the equity is all gone, that means insolvency. So that equity capital, that ownership of the company, must be there. Okay, so realistically, you don't need much equity capital cushion for US bonds or German bonds. On the other hand, dodgy sovereign bonds, derivatives and structured securities, e.g. mortgage-backed securities, may very well decline in value and require a higher equity cushion. They've got to weight these and value them and work out the possibility that they might decline. In short, the sum of the dollar value of assets, A, used to calculate the balance sheet ratios is risk adjusted. Easy, isn't it, really? But the problem came in Basel 1 and 2. They got those wrong. They said that AAA securities like MBS, you only had to have minimal equity capital backing for. This is why Wall Street manufactured them en masse, because all the banks wanted them, because they didn't have to have the equity capital to back it. And government bonds, of course, even of Greece and Spain, the same. No need to hold equity capital for them either. So the banks, especially in Europe, bought these Greek and Spanish, Italian government bonds. They got slightly more interest for them, but didn't have to have that equity capital. Right. That's enough of that. As noted earlier, part of the agreement hammered out by European leaders is, now we're up to date, as noted earlier, part of the agreement hammered out by European leaders is to force or coax continental banks to increase their equity cushions, i.e. their E over A ratios. Ideally, those new equity funds, about $150 billion, are to come from private investors. But with 2/3 of the total needed by banks in countries such as Greece, Italy and Spain, private investors may not step up to the plate. May not. And then what? And the implication obviously from this article, which again, very recommended reading, is then what the countries will come in and supply that cushion that is there to be slaughtered when the assets depreciate in value. So the taxpayer will provide that something in the game, flesh in the game. Is it flesh, blood in the game? Whatever the expression is. And a new argument will break out between Merkel and Sarkozy. Sarkozy will say that the European EFSF shall put that to be slaughtered capital in, and Merkel will insist that individual governments put that equity capital in, meaning that France should put it in for France and Germany should put it in for Germany. And that'll be the argument, and people in the blogosphere will be sitting there going, but what's Spain going to do? What's Italy going to do? Where are they going to get the money from to recapitalise their own banks? And so it goes on. Back to America with solid Wall Street Journal reporting the spending income shortfall, something that I've been going on about this week, the spending income shortfall. And it's a short article just with one chart, so I've cut the paragraph in half because I can't use it all apparently, this copyright stuff. I tried to be reasonably good with the copyright stuff. Anyway, in September, for example, disposable personal income, this is in the United States, so that's disposable personal income, the money left over after taxes and other payments to the government, edged up just 0.2% from a year earlier when adjusted for inflation. Meanwhile, inflation-adjusted consumer spending jumped 2.2% from September 2010. The report suggests that Americans are dipping into savings rather than relying on higher wages in order to boost spending, a trend that economists say is not sustainable in the long term. And as you can see, the red on that chart is the Americans are spending more, although they're having less personal disposable income. So they're either borrowing, which they're not, or dipping into savings. And it's a balance for where all that money is coming from. But we can move on, because in the New York Times, savings rate is dropping and experts are puzzled. It's the same information, just a different angle on it, or a similar angle in fact, really. But it's showing that the experts are puzzled. Where are they getting the money from and why are they doing it? And this is why economics is an impossible science, because it's not a science, because at its heart are the beating hearts of the people, or the brains of the people, which can't be graphed. They will go off and do very strange things. You'll never know what a human will do under circumstances. When the recession began, Americans began to save more of their money, prompting predictions that their financial habits might be changing permanently. Any chance? It'll happen, but it'll be slower than this. But the surge has not been sustained. In September, the nation's savings rate dropped for a third consecutive month. The Commerce Department said on Friday it's now at 3.6%, down to 3.6 again, of personal disposable income, its lowest level since the month the recession began. So they're not saving. End of the article, a good finish. Paul Ashworth, chief United States economist at Capital Economics, offered a partial explanation for the latest change. With interest rates so low, people who have money are earning lower returns. Me. While people who owe money can service their debts for less, younger people with mortgages, etc. In effect, this has resulted in a transfer of wealth from people who are more likely to save, me, say someone nearing retirement age, me-ish, to someone more likely to spend, maybe you, maybe your sons and daughters. Say a young couple with a mortgage and a car loan, they're getting those loans cheap, and the money that was meant to be, if banking worked that way, which it doesn't, if my money was going to be putting in there to be lent to these people, I don't get any return for my lending it to the bank to lend it on to these people who are getting it cheap, and I don't get anything for it. But don't worry, banking doesn't work that way. But that would not account for the whole shift from saving to spending, he said. Maybe households were desperate and didn't know what else to do. You can put off some discretionary spending, but there's a level of spending that you have to follow through on. In other words, the American people are being crushed, and every last dime that they've got, except for the exceptionally rich ones, are being squeezed out of them, either actually or mentally, as in they feel that they've got to maintain their standards, so they have to spend every last dime they have just to maintain those standards, or on the lower incomes just to stay alive. But it's very hard for them, going back to that S&P chart, let's say, that for 11 years, I'm not saying S&P touches the lower people, but it's representative of the fact that incomes aren't going up, and the whole mental thing for Americans after generations of things getting better and better, that for 10, 15, 20 years now things are not getting better and could well be getting worse. Okay, so they're striking out at the government, these Occupy Wall Street things. So in the New York Times CBS News poll, do you approve or disapprove of the way Congress is handling its job? And the approval rating is down into single figures. 9% of Americans polled think that Congress is doing, they approve the way Congress is doing things. Might not get this whole thing read to you, so if I stop halfway, I say goodbye. This is the last thing I wanted to finish on. It's back to the Daily Mail, Robert Harris article, which is very good. In fact, I'll read it, and I think I might just get away with it. A spectre, that's a naughty, ghosty thing, is haunting Europe, a spectre of capitalism. A vast and highly unstable mixture of debt, trillions of dollars of sovereign, corporate and private borrowing accumulated over decades, is strapped to the advanced Western economies like a suicide bomber's gelignite vest. The task facing our politicians is somehow to defuse this bomb without inadvertently triggering the sequence of defaults and bankruptcies that would set it off. No wonder they walk around the problem scratching their heads, prodding it gingerly here and there. The horrible truth is dawning that the problem may well not be technically solvable. For the first time in my life, I am 54, I get the sense of what it must have been like to have lived in my grandparents' or great-grandparents' generation, in 1913, say, or 1937, one feels a great smash coming ever closer, almost in slow motion, and yet there seems to be nothing that can be done to avoid it. Bye.